Welcome everyone to our fourth webinar of this series. It's the last one of the year, unless something special happens and we need an emergency one. But this one is going to be all about year-end planning strategies for individuals. With me today is Angie O'Day, our new client success manager, and David Auer, our founder, and the man who has put together some great tips today for us. As usual, we have this disclaimer in here to let you know that if you want to act on any of these recommendations, we suggest you enter into an engagement and we implement it for you with some true strategy. It's just advice. It's nothing to be acted upon today. All right, Angie, over to you.
All right, thank you, Tyler. We've got a great group today. Thank you, everybody, for attending. We're really looking forward to talking to you. I want to start with our model. This is pretty much how we approach our clients and the journey that we take you on. We first start with saving, so tax minimization and your financial data oversight. And then we start next with the protect, with business structuring and income protection. And then we want to work on that with building and retirement. So having a good exit strategy and financial freedom is a long-term goal. And then impact, so how you want to make a difference and how you want to leave things with your retirement. We do this in a holistic manner. And then moving on to our process. So we will start you off with a strategic blueprint. That's when you're going to get your needs assessments and your recommendations. This is really where we'll kick things off with you so you can see the potential savings and financial freedom that your long-term goal is. And then we will start with onboarding after the blueprint presentation. So that is where we're going to set up all of your entities, data gathering, and then implementation. So setting up and saving, protecting, and going back and actually implementing what was in your blueprint. And then lastly, our quarterly pulse. This is something very unique to our firm. That is where we're going to be reaching out to you every 90 days, being proactive rather than reactive, and moving on with what your tax planning, savings, and all of those things look like in the future. So starting with the agenda. So let's move on to the good stuff. So we're going to start with the latest on the Build Back Better Act and Infrastructure Investment and Jobs Act. And then second, we'll go to 10-year and 2021 tax planning considerations for individuals. And then we will open up our questions. So we will encourage you guys to ask questions so our team can answer any needs or questions you have. So I'm going to turn it over to David Auer so he can tell us what's going on in Washington right now.
Great, thanks, Angie. And by the way, if anyone that's listening to this happened to miss our webinar that we did two weeks ago, which was year-end tax planning for 2021 for businesses, Tyler will put in the chat the link so that you can watch that on YouTube, as well as we did two earlier, more legislative update webinars on all of the legislation that was being considered over the last several months. So I encourage you to listen to those if you'd like to have a full or a deeper dive. Today, what I'm going to do is just talk about where we are since 2 weeks ago when we met. So the latest on the Build Back Better Act, it's hard to say fast 5 times, and the Infrastructure and Jobs Act. As you may have seen in the press, the infrastructure package passed and was signed into law this last Monday. So today is November the 17th. That was signed into law on November 15th. That was the $1.2 trillion package that was going to put $550 billion into immediate infrastructure over the next 5 years, and then several other key programs. Just as a highlight of where that Infrastructure Act is focusing money on, it's in the roads and bridges, public transit, railroads, airports, So quite a significant investment over that 5 years. And then also just making sure that, you know, everyone in the country has access to broadband. So that's that bill. That bill actually did not have any tax increases in it. That's going to be paid through other programs and cost cutting. On the Build Back Better Act, if you're interested in knowing more about the contents of that bill and over the proposals, because it's been changing quite a bit over the last month, you can refer back to our webinar that we did year-end tax planning on the businesses, and I do go into more detail about the latest proposal. However, there was one addition made after our last webinar, and I do want to mention it because it is a tremendous relief for a lot of our clients who live in states where they either have a high income tax and or property tax. So there is in the latest version revision, if you remember, as it relates to your itemized deductions. Ever since 2018, your sales tax, your property, state property tax on your primary residence and second residence, and any income tax that you paid personally was capped at an overall dollar amount of $10,000. So as of right now, this bill, effective for the year 2021, so this is going to be retroactive to January 1st, it will raise that cap from 10,000 up to 80,000. So that's really good news for those of you who live in either high property tax states and or income tax states. So that's the latest on the Build Back Better Act. Now, there has been talk this week that they're going to try to push this through the House as early as this week, but they've said that now for several weeks in a row. So there is a lot of pressure being put on House members to get this bill passed in some version. So we will be tracking that as we have been for the last several months. And if this does end up being passed by the House and the Senate, and looks like the Senate agrees to what the House version is, and it doesn't go back to a joint committee to work out the differences, then it's likely that this will be signed into law. We just don't have any timeline other than what various congressmen are saying, that they're trying to get it completed by. Keep in mind that all of the things in the bill, all of the items in the Build Back Better Act are merely proposals. So what all of the changes that you may have seen or witnessed that have happened over the last month where things got taken off, I would not view those as necessarily completely going away. They've just got put on the shelf. And until this bill gets farther along and through the Senate, we won't really know what this bill is going to have. So I wouldn't let your guard down that this may still have a significant impact for 2022, even though the last proposal, they stripped a lot of things out, made it look like that some of the more detrimental proposals were being taken out. So it's always better to have a plan than to try to predict what Congress is up to. So the most important lesson from watching this legislation is to have a good plan in place, regardless of what happens. And that's what we always recommend to our clients. So let me jump right into the 10 year-end tax planning considerations. I'm going to spend most of my time on the 10th one because this is one that I feel is we've got a short or limited time to take advantage of. So I'm going to cover some of these other ones in more of a summarial fashion. I have provided some details, some tables and charts on some of these slides, and just as for reference, everyone that's listening to this webinar will be live. It's going to be emailed a video or a recording of this presentation along with the slides. And then my hope is that you'll have then these charts and graphs that I'm going to show you as a point of reference to study in a little bit more detail than we'll have time today to do. So the first recommendation, probably more than ever before, and a little bit unusual for most years where we have uncertainty in the tax law, is knowing what I call bracket management, making sure that you know what your tax brackets are this year versus what they could look like next year, and what your potential taxable income is. So for some of you, your income may be somewhat predictable. For others, it may not be. In the case of where you might be expecting a big sale of an asset or something like that, where you might have capital gains consequences in this year versus next year. But as a general rule, if you project that your income is going to go up next year, there could be an opportunity for you to accelerate as much of that income into this year to manage what your marginal bracket would be otherwise. And then the same with shifting deductions. If your income is going to go up next year, then looking at potential deductions that you might be able to postpone and wait till next year. So one good thing about the state income tax or the state and local income tax limitation going up, it does give you an opportunity if you're not at the $80,000 threshold, because you pay less than that in income tax or property tax. It may allow you to prepay or overpay that income tax and to get up to that $80,000 limit if you need extra deductions this year. Also keep in mind that if you have any business expenses or deductible expenses and you prepay those as a cash basis taxpayer, there is a safe harbor rule that allows you to deduct prepaid expenses up to 12 months in advance. So that also gives you some freedom to shift some of those deductions into this year that you otherwise you wouldn't incur until next year. So again, very important to know what your tax brackets are. So if you look at 2021, the IRS just came out with the 2022 rates. As you can see, there's a couple of $100 increase in each of the brackets. If you're a single taxpayer, you don't move into the 37% highest marginal bracket until your taxable income is over $539,000. If you're married filing joint, that top rate doesn't kick in until $647,000. Now, there is a proposal, as I mentioned 2 weeks ago, that for certain taxpayers that make over $10 million, there is a surtax that also is going to apply in 2022. If you're head of household, that top rate kicks in at $539,000. So as you're considering some of these tax strategies that we're going to talk about, it's important to refer back to these pages to see where you are in terms of your marginal tax bracket, so you can at least understand what the tax savings would be and what bracket that you would be potentially moving those deductions or reporting that income in. If you're looking at capital gain income, it's important to know, where you are, especially as you come up close to that 20% highest rate. So if you've got qualified dividend income or capital gain income in this year or going into next year, you can maybe perhaps shelter some of your income and or shift income so that you can stay in that lower 15% tax bracket, and ideally possibly even a 0% tax bracket if you're lucky enough to or unfortunate enough to be in that lower tax bracket, in either case. So knowing your capital gains bracket is a good starting point. Also, the standard deduction for those of you who don't itemize or have potential income tax planning opportunity with other family members, which I'll talk about as another strategy. Actually, I'm sorry. Yep, so I'm sorry. The standard deduction for everyone goes up between a couple $100 to several $100. Married filing joint now is going to be $25,900. So just somewhat of a cost of, or more of an inflationary adjustment from that standpoint. So let's talk about the next recommendation I talk about. Again, it's about bracket management. Is being able to anybody that you're financially supporting, any family members, possibly looking at shifting income down to them to the extent that you have the ability to do that, either by shifting investment income and or putting these family members on payroll. There's pros and cons that you have to make, and potential pitfalls of doing that, from either paying parents that are drawing Social Security. You want to be careful not to have them be paid too much if you're going to employ them. The same with children, need to be paid based on their age appropriate compensation. But knowing what your children's, especially to the extent that their standard deduction, is also another effective way to shift income from your potentially much higher tax bracket. So the next recommendation is to make sure you're also aware of the net investment income tax. These are the threshold amounts that that 3.8% of income tax kicks in. So this is above and beyond your marginal federal income tax and any state income tax that you pay. You might also have a 3.8% tax on your net investment income. That basically covers interest, dividends, capital gains, rent and royalty income, and certain non-qualified annuities. It does not include your wages, any unemployment compensation, the Social Security benefits, and most self-employment income. Keep in mind too that if you had a large sale of an asset, whether it was your personal residence that was not excluded from gain, that could also be subject to the net investment income tax. And under the Build Back Better Act, one of the proposals is to tax pass-through income of S corporations and partnerships, which is going to be a new tax, which will cause a little bit more tax planning to be needed to be done with S corporations and partnerships, just to minimize that tax to the extent that you can. So that's the fourth recommendation. All of these are generally require some quantitative analysis to decide which and how to take advantage of all this. For those of you who are eligible to have a health savings account or a flexible spending account, or potentially both, these are the new limits for 2022, depending on what your age is, if you're 55 or older, with the catch up, and then what the minimum requirements are in terms of deductibles to meet the requirement for a high deductible plan. And then keep in mind that you can't double dip as a general rule on both a health savings account and an employer provided flexible spending account, except in a limited situation where you can have a flexible savings account that applies to vision and dental. That's the one carve out that is allowed where you can dip into both. So that's something to talk to your employer about, possibly having if you also are looking at a health savings account. And then this is where I talk about the having the ability to have a medical savings flexible savings account if you have dental or vision. And they haven't yet pegged the max limit for flexible spending accounts for 2022. So be on the lookout for those if you otherwise have one of those. The sixth item we'd like to mention is consider year-end tax or charitable giving. Now, this could also help you if you have a spike of income this year and you'd otherwise like to shelter that with doing several years worth of charitable giving by the end of this year. If you don't itemize, that is only going to help you, depending on if you're single or married, either $300, whether if you don't itemize deductions, or $600 if you're married filing joint. That's a new addition available to married couples. If you do itemize your deductions, then the new rule for starting last year was that cash contributions other than made to a donor advised fund, so this is any other public charity, you're allowed to contribute up to 100% of your adjusted gross income. The previous rule was up to 60%. So that got changed last year during the COVID pandemic up to 100%. That rule is effective through this year. It has not yet been extended into next year. So if you need to take advantage of that to level out some of your taxable income for this year, that would be something to look at. If you contribute money to a donor advised fund, so those of you who are not familiar with the donor advised fund, that's generally an account that you have access or control over that sits with a public charity that you can make a cash contribution to it, and then you decide when and how much you ultimately give from that donor advised fund to other specific charities. So again, it's another way to control the timing of when you actually give the money to the specific charity of your choice, but it allows you to front end contribute a much larger amount to get the deduction this year if you need it. Gifts of appreciated property to charity are also generally a good idea, rather than selling that appreciated property subject to capital gains tax and then offsetting it with a potential charitable deduction. If you gift the appreciated property, then that deduction, the limitation to that deduction each year is up to 30% of your adjusted gross income. Keep in mind, anytime you make a contribution, whether it's above your 100%, 60%, or 30% limitations, any excess deduction above those limitations carries over for 5 years. So it could be another tax planning strategy that could have a lasting benefit. If you make a significant gift this year, but it happens to be limited, then at least you won't lose it, at least if you can use it up over the next 5 years. And then if you do make gifts out of a C corporation, The previous rule was up to 10% of taxable income. That is now up to 25% of taxable income. So the next tip I'd like to talk about is gain harvesting. That's basically looking at appreciated investments or assets that you have, looking to make the best, keep that down into the lowest possible tax year, and perhaps rather than sell it all in one year that could kick you into that 20% tax bracket, you harvest some of that when you're still at the a lower tax bracket, ideally either the 0 or the 15% bracket. And then another strategy that's fairly popular is to harvest any capital losses that you might have. With the stock market doing what it's been doing lately, this is less common than it has been in other years, where a lot of people are sitting on gains rather than losses. I will say, though, if you have both in your portfolio, what you'd want to do is make sure you perhaps capitalize or net your capital losses with your capital gains in that year. Otherwise, if you sell all your gains in one year and have to pay the tax on capital gain rates, and then you sell your losses the next year, you might be stuck under that $3,000 annual limit in terms of taking capital losses if you don't have them to net. And also be aware of the wash rule. So that is basically a 61-day window, 30 days before you sell an investment at a loss and or purchase another one. You need to make sure that new investment, if it's substantially identical to the one you're selling, is outside of that 30-day window, either before you sell the asset that you've lost money at, or you buy the replacement. So keep in mind the wash rules. The 8th tip is maximize your employer retirement plan contributions. What I've done here is a list of the 2022 contribution limits. So 401ks, 403bs, those type of plans, the limit or the cap is now up to 20,500, 6,500 for a makeup or a catch-up contribution. Simple plans are up to $14,000, and with a catch-up provision of $3,000. And then defined contribution plans are now at 61,000 cap. And then if you have a defined benefit plan, the annual compensation limit is now up to 245,000. I'm sorry, 305,000. The annual limitation is 245. So you can see these limits down as far as looking at what the maximum contributions are going into 2022. And certainly if you can max those out for this year if you need the extra deduction. And the 9th tip is considering either a traditional backdoor or Roth IRA contribution. So part of this proposal in the Build Back Better Act is going to potentially terminate the ability for backdoor Roth contributions. So if you are not familiar with a backdoor Roth, that's basically where you would contribute to a non-deductible traditional IRA and then roll that over to a Roth IRA to get around the income limitations, which I'll talk about next. But in order to know whether it makes more sense to contribute to a traditional or backdoor or straight to a Roth, requires you to at least know what the limitations are. So what I have here are the limitations if you are looking at making a traditional IRA contribution. Again, you have until April 15th of next year to make this contribution. And if you choose to have it be deductible, to then be deductible on this year's tax return. It depends on whether or not you are covered or your spouse is covered by an employer provided plan at work. And if you are covered by a plan, then if you're single, there's a phase out of what you can deduct between $65,000 and $75,000. And married filing joint is the phase out range is $104,000 to $124,000. So any income over modified adjusted gross income over $124,000, you as a married filing joint, you cannot deduct a traditional IRA contribution. And then if you're married filing separate, and I don't know why this amount is so low, but they cap that at $10,000. And it's phased out completely over $10,000 of adjusted gross income. If you are not covered by a retirement plan at work, then as a general, and your spouse is not covered or is not covered, there you get the full deduction no matter what your filing status is. And then if your If you do have a spouse that's covered, then it's a greater amount that your income is subject to in terms of phase out, whether you're married filing joint, and then it's the same 10,000 if you're married filing separately. So when you get this handout, you can check these numbers, see what your projected income is to know whether or not a traditional IRA contribution makes sense based on your tax bracket and goals, or your and what your long-term goals are in terms of accumulating tax deferred retirement. If you're looking at a Roth IRA contribution, be aware that there is also a phase out depending on what your modified adjusted gross income is. If you're married filing joint and your income's under $198,000, you can contribute the full amount to a Roth directly without having to go through the back door. But that ability gets phased out if your income's over 208. If you're married filing separate, here's that previous $10,000 limit that would allow you to contribute. And then if you're single, that phase out is between 125,000 and 140,000. So if you're single with modified adjusted gross income under 125,000, you can contribute the full amount to the Roth. Now, the last tip I want to spend a little bit more time on, because this may be impacted by the Build Back Better Act, and it's been a very hot topic with all of our clients that have accumulated a significant amount of their retirement in tax deferred retirement. So I want to first talk about what are some of the concepts behind a Roth if you're not completely familiar with them. Generally, a Roth conversion is going to be a rollover, a transfer from a traditional tax-deferred IRA or other qualified plan directly into a Roth IRA. So the type of people, taxpayers that can take advantage of Roth conversions are people that have money in a traditional IRA, and also individuals who have been had a SEP or a simple IRA for at least 2 years. If the plan allows it, you can also make rollovers, conversions from 401ks, 403bs, and 457 plans. So what this list does not include are profit sharing plan and defined benefit plans. And all that means is that you first have to roll, to the extent that the plan allows you to take in-service distributions, or you've terminated service and you now can roll that money over, you first need to roll it over to a traditional IRA before you can then convert it into a Roth. If you don't have one of these, if you have a type of retirement plan that's not a 401k, 403b, or 457. So a couple other concepts are that the Roth conversion is effective in the year that you take the money out of that IRA. So you have 60 days to convert that over to the Roth. If it does help you to do, and this is something that we do with our clients when we're contemplating Roth conversions, is to spread that Roth conversion potentially out over several years in order to keep that marginal tax bracket down to a manageable level each year, rather than doing it all in 1 year where it would cause your marginal tax bracket to spike up into a higher bracket. Spouses who inherit IRAs or plans can roll their money, that amount that they receive, over to their own Roth IRA or their own IRA, and then convert it from there. Non-spouse IRA beneficiaries cannot convert an inherited IRA into a Roth IRA, however. So just be careful of, if you, depending on what type of traditional plan you have, whether it's an inherited or spousal, or if it's your own, know for sure, know which kind are eligible and which ones aren't. Other concepts are income taxes are obviously going to be due when you make the Roth conversion. You cannot change your mind once you do a Roth conversion, so they're permanent. Income taxes will have to be paid at whatever the ordinary tax bracket is on all money that you take or convert over to the Roth IRA. So you definitely want to make sure you've got the, if you're not going to use up some of your IRA proceeds to pay the tax, which you got to be careful of if you're under 59.5, because that amount may be also subject to the 10% early withdrawal penalty. You want to make sure you've got adequate resources, ideally, to pay those taxes on the Roth conversion out of other funds. The nice thing about the Roth IRAs is they will grow tax-free as long as you meet the requirements, and it'll provide tax-free income for life, which is obviously the best type of retirement income to have, everything else being the same. And however, they would be that Roth IRA would be included in the owner's taxable estate. So just keep that in mind, when you're considering estate planning, or whether or not you're bumping up next to the estate tax exemptions. Distributions from Roth IRAs are tax-free as long as you've had a Roth IRA account open for at least 5 years. So it doesn't have to be per se the money you have most recently rolled over to the Roth, but as long as you've had a Roth account that you started 5 years before, and at the age of 59 and a half, so you need to meet both of those tests, then the distributions can be tax-free. As well as that Roth IRA is ultimately tax-free to the beneficiaries that you name for that Roth. So it's probably the best type of inheritance that any person can imagine getting, is to give them tax-free income and wealth. Also, as you may know, the rules changed a year ago, or this last year, relating to required distributions distributions after death. So your beneficiaries would have to take that money out of their Roth IRA within a 10-year time period. So whether that, and since it's tax-free, most people are going to wait until the end of the 10th year to do that. In either case, that's tax-free to the beneficiaries. There is no more stretch IRAs for most taxpayers out there. There are some limited examples where you can still do a stretch IRA. Also, something important to know about Roth IRAs is they are not subject to the required minimum distribution requirements, which start at age 72 now. So just keep that in mind as you're planning for your retirement income, whether it's going to be subject to the RMD rules and potentially push you into a higher tax bracket. That would be something also to consider about potentially doing a Roth conversion. So several questions that need to be asked on whether or not a Roth conversion can be done. One of the most important is, how soon will those funds be needed? The longer the period, the better a Roth conversion will make sense. Who will be the beneficiaries? So to the extent that you have beneficiaries that are in a high tax bracket, a Roth may be much more valuable to them than a traditional tax deferred retirement. What do you think future tax rates are going to be? Generally speaking, most people, I think, are now expecting tax rates to go up, if not in the short term, over the long run. So that weighs into that decision. And then, what will the tax result be when you do the conversion? So to the extent that you can manage your tax bracket and keep it low while you're doing a Roth conversion, that would be ideal. And then, like I mentioned previously, where the money is going to come to pay the tax on the conversion. Ideally, you'd want to have money outside of the rollover or the conversion amount to pay those taxes, and then whether or not it's important to have retirement income that is not subject to the RMD rules. A couple of reasons to think about converting, is that you've met the 5-year test, or you believe you will. You don't plan to take that income out for a number of years, and you've met the test of either being 59 and a half years old, or you've had a disability or death. Another consideration is if you want to, especially this is popular with younger children, that you perhaps contributed to their Roth IRA if they had earned income, and that is to allow them to have the $10,000 lifetime amount to put toward a new house. And a few other reasons to convert is getting around the RMD rules, allowing a spouse to then roll that Roth account over to their own account, and then potentially pushing that tax-free income to beneficiaries who may be in a higher tax bracket and could certainly benefit from having tax-free income over that 10-year time period that they would have to take that money out. And then it also keep in mind too that distributions that come out of a traditional retirement account or qualified plan do count as net investment income for purposes of that 3.8% tax, whereas distributions out of a Roth are not subject to that. And then same thing with like I mentioned with beneficiaries is identifying what their tax bracket could be potentially, and whether or not it makes sense to give them tax deferred income, which if they're in a low tax bracket, or you can spread that traditional IRA distribution out over multiple beneficiaries, then perhaps that is taxed at a lower rate versus if it had all been dumped on them in 1 year, where it might be push them up into a higher bracket. And then some strategies that are out there to offset or mitigate the consequences of a Roth is one, if you happen to have a loss from a business that you can capture that might create a net operating loss. We've had a couple of clients that have had that circumstance over the last year or so with the COVID crisis. That this could be an ideal time to offset that net operating loss with a Roth conversion. There are ways of pushing that IRA into a self-directed IRA, which would own an LLC, and then by converting a part of that LLC every year over several years, getting what is allowed to be a valuation discount on how much that would be taxable, is a way to squeeze the value of that IRA down and therefore minimize taxes. The family endowment plan is another very popular way to offset that income effect. You can contribute either appreciated property to the family endowment plan, which would be subject to the 30% AGI limitation, or cash, which is subject to the 60% AGI limitation, and that could go a long way to shelter that the income tax effect of doing a conversion. And then there are just generally speaking, implementing all the other tax planning strategies that are available that we generally advise our clients to consider. That could also keep your taxable income down, which would make more sense to do a Roth conversion in those years. A couple of reasons not to do a conversion is the fact that you have to pay this tax up front, and that it's coming out of the tax deferred retirement account. That would be potentially a reason not to do it. The fact that it's a permanent decision, that you can't change this if you're not sure that you want to do this, that would be a reason. And then the last another reason is the legislative risk. Knock on wood, all of the Roth IRAs that people have would be grandfathered in, and potentially only new Roth IRAs would be subject to any changes that Congress has, but that's not always a guarantee. And then some of the side effects, that would weigh in not making a conversion would be that it could spike your adjusted gross income, which would cause you to be subject to certain phase outs of other deductions that we call a stealth tax. But basically that would diminish the tax benefit of doing the conversion. And then if you're not looking at holding this Roth long term, then it also probably wouldn't make sense, and especially if if you didn't meet the 5-year test by the time you wanted to take the money out. If you think future tax rates for the beneficiaries that are going to receive a tax deferred retirement account that you might have are going to be in a lower tax bracket than you are today, then it also may make sense not to take the money out. But if you can spread that out over multiple beneficiaries and keep them in a lower tax bracket, especially if you spread that out over that 10-year time period, that may mitigate some of that. And then just like I mentioned before, some of the phase outs of some of the deductions, if you anticipate that you may need to take money out that otherwise for medical expenses or business losses, those all weigh into that decision as well. So in simple terms, if everything else is the same, if tax rates stay the same, if you have a traditional IRA versus a Roth IRA, I show an example here where that really doesn't matter. There's not going to be that big of a benefit. Whether you have money in a traditional IRA, it grows it doubles in size between now and the time death, and then you end up having to pay a 40% income tax when it's taken out, versus a Roth IRA where you paid the income tax first, and then it's doubled in value. It goes to your beneficiaries tax-free. In either case, everything else being the same, growth rate and tax rate, they're both going to be equal to the same amount at the end of the day. So again, that it only makes sense when tax rates generally are going to go down, and the longer time period you have to leave it in the Roth. when you're looking at the ideal sweet spot to do a Roth conversion, your goal is to try to keep obviously that tax consequences down below the rate that you think you're going to have when you take that tax that you otherwise would take that tax deferred retirement income. Be careful, be mindful that, when you hit that 24% tax bracket, the net investment income tax may kick in. And then you also have the phase out of where the section 199A threshold hits if you're eligible for that 20% deduction. So the optimal range, the tax bracket that most people try to get into is that 24% tax bracket before you jump all the way up to 32%. So that requires some calculations, as well as being able to do a fairly accurate projection of your taxable income to know exactly where you fall. So I'm going to turn it back to Angie. She'll just reiterate what our process is, and we'll go straight into questions.
Thank you, David. Yes, everybody, just to recap what I spoke about in the beginning, with our process, we begin with that strategic blueprint, doing onboarding and then implementation, and lastly, the quarterly pulse. And I would encourage you to have a call with me. I know Tyler's put a link to make a connection with me so we could talk further and do more of a deep dive about the blueprint process. So a couple of ways we could do that. As mentioned, you could schedule a 30-minute Zoom call with me and using the link that is in the question in the chat box on this call. And then also you could go with the fastest method, which is the strategic blueprint, just doing it directly with us, especially with the end of the year wrapping up. That would be the faster way to begin that process with us. Thank you.
And I'll just highlight that, we are in the middle of November. We generally wrap up all of our tax planning with our clients by the end of November, so that we have at least a month to get everything put in place, especially because we like to enjoy the Christmas holidays like everyone else does. So if this is something you're interested in, I would highly encourage you, to the extent that you don't already have a tax plan put in place and you're executing on it, to certainly reach out to Angie to schedule that first call, because it takes a couple of weeks for us to get all of our recommendations put together, and then it'll take several weeks, if not a month, to get things put in place, if we can, by the end of the year. So let's move into the questions. So do we have any questions?
We don't have any questions, but I will talk for 30 seconds, and hopefully if someone has a question out there, let us have it. We do want to let everyone know that if something were to happen with legislation that would have a big impact on your taxes, David and I have discussed doing a kind of an emergency webcast at some point between now and the end of the year. And then we're also, of course, working on a full webinar schedule for 2022. So definitely be on the lookout for that in your emails as we get closer to the new year. Still don't have any questions coming in, so we might be off the hook tonight on questions, which means we can move to conclude.
Great. Well, again, I want to thank everyone for joining us today. We've appreciated your participation, and certainly welcome any questions, an opportunity to work with each one of you if you aren't already a client of ours. So thank you, everyone, for your time tonight, and we look forward to talking to you soon.
Thank you.